Good morning, gentlemen. This is Clueless Trading Frank. It's approximately 9:39 a.m. On Saturday morning, September 30th, 2017. We have two terrific members in attendance. We have Jose and we have Tim. And this is a special ACS sessions to cover some of the important basics of charts as well as answering questions on trade management. So we shall begin. This session will be recorded and uploaded to the YouTube channel, so you guys can listen to it at any given time to refresh your memory. And full disclosure, this is purely for financial education and not for any solicitation. So let's kick off by starting with the basics of, which I consider to be extremely important, basic or not, of breakouts, which is what we're undergoing right now. I'll leave the second portion of this webinar open to questions. That works for you guys?
That's fine.
Okay.
Yeah, it's good, Frank.
Okay, good. So first of all, I put out I put out these unmarked charts. This is what just a regular chart looks like, without any structure on it. And a couple of things I do want to mention before I start. Options trading is risky business. All right, there's no question about it. And the only way that you can minimize the risk or quantify the risk, to for a better choice of words, to understand what your maximum loss or what your maximum gain can be, is to really try to understand the tactical charts that I'm putting across. I always share what's worked for me. I am not a traditional type of technician or trader like a lot of the other services are, and that's fine. So in a way, it's a little bit more advanced than what is taught in other places. But I highly recommend that both of you, given the fact that you guys are very new to this particular game, that you review and study some of the other stuff that's out there. You know, it's no one person has the answer to everything. Collectively, we can you can be you can gather a lot of knowledge and wisdom. It's really as simple as that. Everyone has their own strengths. I have my own strength, and my strength is basically predictive charting. In other words, getting into the game or the trade, as you both know, and Tim knows quite well, ahead of the game. And when you place trades ahead of what something is going to happen, it's always the most difficult time. No question about it. No question about it. The second point is that in order to do effective options trading, where you have to dollar cost average, buy something a little bit cheaper, bring the cost down, and then wait for these monumental breakouts. This is not the first time it's happened. In the meantime, the market basically jostles around and throws people off. I'm showing, again, in a few minutes, I'll put my structure charts in there, and as you know, I walk people through it, like Tim very simply said on Stock Twits yesterday, that I've been talking about this market going to 2520, if not higher, for weeks now, for weeks, if not for months. So the bottom line is, in order to get there, it doesn't happen in a straight line. So as a new trader, and especially an options trader, you have to accept that fully, that there will be a lot of volatility, a lot of what do you call this? This is obviously a 5-minute chart, the zoomed in version, so it looks more amplified, right? This is the zoomed out version, going back to the beginning of the month. So the point is that in order to get and where it wants to go, which I've shown repeatedly on my longer term charts, it will take a very windy road to do that. And that windy road is known as volatility. And that volatility throws people off, throws me off at times. But I stick to a very strict discipline. And just the way, like I say, trading is like war. You got to have the reconnaissance. You got to hit when the enemy is weak or when they're sleeping or whatever they're doing. You got to catch them. You got to ambush them. So what I try to do with my tactical charts is I try to ambush the market. Now, in order to do that and placing trades in all these extremely tricky situations, okay, it requires a lot of technical discipline. It doesn't come in one day, but it's not that hard. Trust me. Okay, it's really not that hard, and it requires patience and it requires capital. So the capital part, which is the money part, is a constraint for a lot of people. Look, I'd like to buy big chunks of every one of my alerts, which have worked tremendously, but I'm even constrained in capital. I'm not running a multi-million-dollar portfolio here on the trading side. Okay, we're not talking about investing; we're talking about trading. So the point is that making big chunks of money every week requires a large amount of capital. It also carries large amount of risk. One of the things that I always recommend, always told people, and you both will agree with me, is that the larger your dollar amount is, your fluctuations on your portfolio on a given day is going to be significantly large. You can be down $8,000-9,000 within minutes if you have multiple positions with sizable, contracts or more. So can the average person who's just starting out handle that type of movement? And I'm just giving you a rough figure, which is the facts. $8,000 to $10,000 type of fluctuation because of these volatility moves? No, I don't think so. In due time, I'm sure you guys will. And God willing, you'll get there. All right? So the larger your position sizes are, that's why I put a big dollar sign, right? The more you got to deal with this type of volatility, and mentally, very few traders are prepared. Even when they have a lot of money, they are not mentally prepared because they are guiding their trades through their emotional aspect of the brain. When a drop like this happens, okay, they're like, there we go, the falling off the cliff. Except when I put my structured charts out there, you know pretty much where it's going to go, give or take, regardless of what the news is. Regardless of North Korea's testing another missile, regardless of a tweet that's coming out of Washington, D.C., whatever the case may be. That's what keeps you in the game. And this is just a naked chart, right? Without my structures on it. So capital is extremely important. Always got to have some cash on the side so that if something you buy, an option you buy at 2 goes down to 1 or 50 cents for that matter, which happens with SPX calls as SPYs, right? That you are willing to basically buy here, lower your cost basis down to $1.25. That's the average of 2 and 50 cents. And then watch this type of move where it goes to $4. You make significant sums of money. If the markets went up in a straight line, just like this, or maybe just a little bit like that, then the dollar cost averaging part, in other words, buying here and then buying here, selling here, buying here, and cost averaging, let's say it was 2 here, it's 50 cents here, then you buy I'm giving you a simple example, buy one contract each, your cost now is $1.25, and then you get this breakout, which I knew was going to happen. And it's not I knew it was going to happen. I mean, I was showing that on the charts all the way through. So prepared traders, small or big, basically cost averaged, and maybe they trade some of the scalps, which is fine. But if they cost average down, sat on it for what? This is not like days and days. You're talking about just 1 week or 5 or 6 days, right? Right there. Yeah. They made a bundle. So capital is extremely important. The risk part can be minimized and the emotional part subdued or put, away. Not completely away. We're all emotional. Come on. It's real money we're dealing with. We're not paper trading here. So bottom line is that by understanding the structure charts that we're going to get into, and I'm going to walk you guys through it point by point, even though you both have seen it, especially Tim sees it every day. So the third part is the discipline of, or the mental framework as to believing which direction, what broader direction the market's traveling in, which I make very, very clear with a simple term, with as my charts are put out there. I say upside is intact. Now, I don't say that lightly. There's a lot of work that's going on behind the scenes in my brain, on my computer screens, before I put a comment down. I'm not trying to lure people into doing something because it doesn't make me any money to put them in harm's way. So, and I'm in the same boat. So bottom line is that these things are extremely important. You got to have capital. Even with smaller capital, you can't put everything at one go because these things are going to happen. Look, it went from here to here. But what do you do in the meantime? That is volatility. Volatility is designed by the computers, okay? By the algorithmic high frequency trading computers, what we call algo HFT, to shake you out on the long side and on the short side. I've had short trades that didn't work. I don't short that much in these type of markets. You got to be very quick when you're shorting something. So the bottom line is volatility. You have to accept the fact. It's a very hard thing to accept, by the way. The volatility is not meant to make you comfortable. Volatility, or chop, as commonly known, is meant to make you nervous, is to make you scared. And the only way you can minimize that fear or the scared component is by truly tracking the tactical charts. For people who are short-term trading, they have to watch the screens. They have to watch my Twitter feed. They have to watch their own screens much more regularly. People who are looking to a longer type of swing. I remember buying the 2,550 calls like 2 months ago. Even they worked, and we're not even at 2,550 yet. So that's a swing trade. You buy maybe a little bit more, and you sit there. You cannot be thrown off by what happens on a daily basis unless the picture changes. And my last video, which I made very clear, I showed the picture of the S&P 500. You know that. And I showed that if the directional bias is up, then you can sit on that swing trade. Charts don't lie. They fake out. They don't lie, but they fake out primarily because of this type of movements. Now, these movements are structured patterns that are very known to me, but exactly when they're going to happen, obviously nobody, I don't know whether there's going to be a quick sell-off here while it's holding a nice, creates a double bottom. I don't know that's going to happen in the next 2 minutes. That's dictated by fast-moving computers. That's dictated by news flow that's coming out and everything. So it's a learning process. That's why you guys are here on this, very early for you guys out there in the West Coast. And I commend you both for it, to be honest with you, because nobody sat me down and taught me trading. I come from a background of Wall Street, but that was on the money management side. We managed money. I wasn't a professional trader there. I should trade for myself on the side. But I had an opportunity to sit with some of the biggest names in their Wall Street web seminars and stuff. Big technical chartists that some of them are still around. And I learned the traditional way, and then I adapted it to my way, the way I look at it. So far so good. You got to understand what I said?
Yeah, it makes perfect sense, Frank.
Yep. Just, these are the simple facts, not the fake news, as I like to call it. So now that we have this, let's drop the structured version. There you go. See the difference? There's your unstructured, 1 second, this is 1 hour. Yeah. Unstructured version going back to this is the structured version, the tactical version, the way I put it. And drawing this chart is not like a cakewalk. Eventually you guys will be able to do that on yourself. It just takes, you just have to keep on practicing it. So this is back on August 18th. So now if we look at the thing on August 18th, so this is August 18th. This is the same chart.
Hey, Frank, I have a quick question for you.
Go ahead.
How do you decide your dates? I know you were saying that 25/20
Okay,
October.
I'll answer your questions in a second. Like I said, I'll leave it open for a bunch of questions. I just don't want to lose my flow, my
I
thought
got you.
process. Yeah, no problem. So here's your same chart from going all the way back to the end of going all the way back to the end of August. There. See the difference? This is your naked chart, and this is the structured version. And that structured version is your detailed roadmap. And I want you guys to basically just quickly, while you're looking at your screens, look at the difference. This chart tells you pretty much nothing. Correct?
Yeah.
It doesn't tell me anything. I mean, it tells me something because I've been looking at charts for a long time. But this chart tells you a lot. It tells you where it can drop to, where it's going to bounce from, what it's going to do, where it's going to head. And that's really what it's all about. So let's close this out. Let's expand this. So this has been shown all the time. I'm going to just show you the longer term view, which I've done repeatedly on the Twitter feed, but doing it again right now. And there should be a big sell. This is the big sell here. If and when it gets there. One other very important thing is, and I've been saying this for hundreds of times, but this is the most critical factor. All my members and traders have to use at least one platform that mimics or is the same as mine. Investing.com is probably one of the best, easiest, aside from Thinkorswim, easiest platforms that one can trade off by looking at my work, looking at the same chart on their screen. Even if it's not structured this way, they can try to do it. It's very simple. You just take lines and just draw them the same way. But if you don't have a platform that is similar to mine, you will most probably not get the same amount of information, which means make the same amount of money as in percentage wise when you're trading. So I just want to be very clear about that. People say, oh, I'm using this and that. Okay, that's fine. I'm not telling people what to use, not use. But if your charts don't match mine, then how the heck are you going to see the structured move of what is going on? It's very simple. You guys get it?
Yeah.
Yeah. And investing.com is free. I don't pay these guys. The only thing I paid for, I think $30 for the year for this service is just to remove the ads. So aside from that, I'm not paying like $30 a month to subscribe to this platform. It's free and it's brilliant. It's very iPhone friendly. The app is great. And I highly suggest that you guys start using it right away. And if you're not using it, then you're doing yourself a disfavor. So saying all that, the structured version is two, and I'm going to walk you guys through this because this is important for your trade management, is you got two very wide channels. That's why it's in deep blue, right? Right there. And this is the big channel that the market, if it enters, just rips the heads out of the shorts. We haven't even entered that channel. See that? That's the funny part. People sitting around saying, oh, market's at new highs, it's going to crash and burn. Yeah, great. If you look at this chart here, and this is a channel, these things, just the way it works. we haven't even entered the upper end of this channel. I mean, the lower, we haven't even entered into this wide power channel that's waiting to be entered. Now, is it going to be a straight line up? Absolutely not. Like I said, it's probably going to hit that 25-30 level or thereabouts, because that's that level right there. And then it's, then it's going to start doing that volatility move. Again, this is a one-day thing, which was huge. Might look small on the charts, but this is huge. This is very similar to this. My eyes picked this up real fast. What happened once you had that the big gap up after Hurricane Irma, right, on the markets? It kept on going up for the next day or so, and then the following day, it kind of moved sideways. Then it broke out again into this channel that the market traded in for a few weeks. And this is the tough one. When the markets go into this trading range, everybody in their head is looking for a breakout, Or the ones who are always scared of the market, they're looking for a breakdown. But all the market's doing is staying within a very tight band known as a trading channel or range. And that range was 2487 and roughly 2509. So you're looking at 22 points, right? Yeah, 87 minus 9 is 22 points, which was roughly a trading range. This is the trading range, okay? This is your trading range right there of roughly about 120 Dow points. But 120 Dow points might not seem much to somebody who's not a trader, but 120 Dow points when the market's jostling around 50, 60 points every other day is creating havoc with individual stocks, correct?
Yeah.
Exactly. So this picture allows you to stay with the trade. Now, not every stock's going to go up on a day that the market's higher. Not every stock's going to be down when the lower. Every stock is in a different category. Even within a particular sector, it's going to be some individual stocks that are going to rip higher. Some of them are going to be down. But I'm showing you the actual mechanics of the overall SPX SPYs and things of that sort. The Russell 2000 went up like a beast. I don't have time to cover that today. I mean, that thing went up just nuts from the time that I said buy the heck out of it. The IWM. And every single bozo out there, big shot guys making 20 million to deliver wrong information, said the Russell 2000 or the US small cap growth was going to die. You remember that, Tim?
Yeah, there's a lot of
There was
naysayers.
lot of negative chatter. The Russell 2000 not going to be there. And when it woke up, and that was it. That's another day's technical story. It just basically ripped every day. That's the way it works. That's just the way it works. And I can sit here and explain 14 plus years on the job that I did to explain to you. I can't even begin to explain the games that are played. The US economy is in fine shape. The global economy is doing well. So why shouldn't markets go higher? That's the only thing you got to think about. You got it? And that's it. That's it. Even if we didn't get a tax proposal, markets would be higher, believe it or not, because corporate earnings are managed very well. And we don't even have a full-scale tax plan yet, other than some guidelines as to what they're doing. When it actually hits the ground, which is going to be later this year, companies will readjust their earnings higher, right? Because their tax rates are lower. You understand that part?
Yeah.
Exactly. If your tax rate now goes down to 0, you don't have to pay Uncle Sam any dollars, which would be great. The bottom line is there's no Social Security tax. There's no whatever tax, payroll tax. Well, wouldn't you keep more money in your pocket? It's the same thing with corporate companies. If their tax rate is cut, they keep more money. That means earnings per share goes higher. Market should go higher. So that's the bigger picture. Tim, ask your question, please.
What's that, Frank?
I said, go ahead and ask your question that you were asking.
Oh, so I know you put out the, you've been saying for like the last month or two to buy October 2520s. What's the difference? I mean, how do you see October versus like, November or December? Like what's
okay, the answer to the question is that I look, I don't want to go out that far. That's just my opinion, because there's going to be a lot of volatility in the middle by the time we get to November. So why the heck should I pay up all the way to November, which is going to cost me more on those options? If there was no volatility, then I would say, okay, I'm just going to buy remember, October options are cheaper than November, right?
Right, just based on the time decay.
Don't get into the technical. I'm just saying the closer months are cheaper than the further months. Okay? So the bottom line is, why should I pay up more knowing that by the time we get to November, there's going to be more chop, and October is a tricky month in the middle. They might have a nice little drop there. So why should I pay up? Here's November, let's say. All right? And here's October. I'm sorry, here's October. And here is when I started buying those calls, August. And this is September. So my point is that why am I going to pay bigger dollars? Let's say, I'm just giving a side example. Let's say $4 for the same calls, when in October I can pay $2. Knowing that I'm going to make some decent money, there is going to be volatility. That's a guarantee. That's a given. That the market's going to basically take a volatile route before it gets there. So why should I pay up 4? I'd rather trade that 2, which goes to 4, okay, on these shorter term moves, take that money, trade the volatility on the short side, which I'm going to be doing soon. It's going to be quick. It's going to be sharp, but it's going to be a fast move. Once we hit this, there's going to be a lot of jostling. It's not just going to be like that. It could be a sharp move down here. Hopefully holds the trend line. If it doesn't, it's going to come to the lower end of this range. So all this stuff is going to happen along the way. So that's the answer to your question. All right? Hello?
All right, Frank, thanks. I got it.
Yeah. I determine it based on the fact. Hold on one second. I dropped a little bit of my coffee. Hold on. Now, saying all that, Tim, and Jose, you can understand this too. Every trader has their own sort of. They have to use their own discretion. If they want to buy November, fine with me. I just personally don't think that it's cost effective to pay so much more, knowing those options are going to go down in mid-October, based on my strategic forecast. Then I can buy them cheaper. And those strategic forecasts are based on these charts. We got a major resistance level here. You see this line here? I mean, that's kind of like self-explanatory right there. You just don't enter these wide channels, these type of wide channels, and not incur massive resistance. Now, Jose, you understand the resistance part, right? Simply means there's a lot of selling, and it's like a wall. Like in order to break through a wall and go to the other side, you're gonna see sellers here. That's fine. So I'm going to be selling hard around this level, seeing how the market is reacting. I'll put my alerts out. I see another breakup. That means the market's going to go straight up to 25.50. Now, an option, when you're doing an option, Jose, just so you know that, You don't have to reach that strike price. If we bought 2550s, you don't need, and when the market was at 2500, okay, pay $2 for it, and by the time it hits 2550, it's $6. All right, so that's 200% on your money. It's 3 times the money, but 200% in profits. You know, that's the way numbers work. So you don't have to reach 2550. As it's moving towards that level, your option price is increasing accordingly. People think that they have to hit that 2550 in order to make money. No, you don't have to hit that number, as long as you're moving in that direction. Am I clear on that?
Yeah.
Yeah, as long as you're moving in that direction, your option will go higher. Option price will go higher. Option, look, I cannot explain the full mechanics. Options are derivatives. They are mathematical derivatives of a stock price. You have a stock price. Let's say stock is at 10. Let's say stock is at 100. And let's say an option is priced a month out at, let's say, $4. There's a lot of stuff that goes in there. Like Tim said, there is time decay. Option has 2 things going with it. Price, known as intrinsic value. Okay, that's the underlying value of the option. Intrinsic value. And then you have time value. These are, let's say, November's, next month. So there's time value plus time value. Now, I'm not going to give you guys a detailed analysis of option derivative movement stuff. Highly suggest. There are tons of fantastic videos on YouTube or even on the Chicago Board of Options Exchange, cboe.com. Okay? To go listen to those, because it's a different world. And I don't want to get that complicated. This is the simplest way of looking at it. This is the dollar value. This is the time value. So as you're approaching November and the stock has not moved from 100 that much, and this is what we run into all the time. Let's say it's still stuck around 105. So the time is running out because you're approaching November and the stocks really hasn't really moved much. Well, guess what? Your option price will drop. And we see that all the time. That's the risk part. There is no one single method, but there are guys who just are options geniuses, not market geniuses like me, all right? But options geniuses who do all kinds of strategies and stuff, I don't really bother with it that much. But you can do different, strikes, you can do a spread, you can do all that. I highly suggest, guys, watch those videos, tons of them on YouTube, and they walk you through it. That's a totally different ball game. Am I clear on that?
Yes.
Yep. I'm a straight shooter when it comes to options. They're going up, they're going down. In the meantime, I'm managing it through dollar cost averaging. Now, why am I successful more often than not? Is because my charts are so accurate. That's all. And it doesn't mean that, it's going to happen every 5 minutes. But it happens a lot. So, so this chart, the way you guys read it to keep, each of these patterns and stuff, I'm not asking you guys to know this right away or even see it. I see this coming before it happens. This is known as a bear flag, where it falls, it starts to go up a little bit, and then bang, makes another step down. This is another bear flag. It starts to rise, boom, falls again. Then creates a double bottom. But each of those are, this is right before the storm. So each of those are shown via these lines. Each of these lines means that these are supports if it's higher, if the chart is higher than that. Big support in red lines, and the higher levels where the markets can go to, and those are those lines. Now, this type of breakout can be just thrown off in one go, meaning like, oh, it's not just a one-day thing. It doesn't mean we're just going to open up on Monday and go in a straight line higher. We could. Did you see the last news I posted on Twitter?
When, yesterday?
No, right now.
No, I didn't
Before
see
I
it.
started, read this. I knew this. I even said that on my video. They're talking behind the scenes. That's international diplomacy.
Okay.
Okay? In direct communication with North Korea, coming from our Secretary of State. This is not a joke. Do you know how positive that is for global markets?
Mm-hmm.
Just imagine. Because that's what world powers do. Remember who was the famous Churchill once said, Winston Churchill, you talk to your enemies. You negotiate with your enemies, not with your friends. You get it?
Yeah.
Yeah. That's what, I knew they were talking behind the scenes. I even said that in one of my videos. We're not going to get into full-scale firefight with North Korea unless they really do something like they actually land a missile on Japan or South Korea or something. Then we'll bomb the crap out of their facilities. But the problem is that their nuclear facilities are 5 miles under the ground. So how the heck even those 40,000-pound JDAMs are not going to get there? You know what I'm saying?
Mm-hmm.
And we ain't getting into a nuclear war with anybody. That's for sure. Because then we're all toast. So this is huge. So does this could have a very positive global ramification now that Rex Tillerson, not a rumor from a news outlet, Rex Tillerson, Secretary of State, the most powerful Secretary of State in the world, had just said, "Oh, we're talking to North Korea." Now there might be another headline this weekend saying, "Yeah, talks failed." But based on this, we could very easily ramp up. The shorts at this point are scared shit.
Yeah.
The hardcore shorts, they are. They're like, what? Whatever the case may be, I don't really care. I'm relying on my chart. I see a breakdown, I will short. Okay? But given this news, it is logical to assume that we're going to break into this upper channel. Now, all hell breaks loose. And by the time people get excited, or traders out there get excited, we're going to be in that 2540 to 2550 range, which will be big sell programs will hit. Big sell programs will hit here too. That's why there's a red arrow. Somebody says, "Well, how do you know?" Well, don't ask me, well, how do I know? It's like asking a surgeon, a doctor, like, "Well, how do you know this is going to be this?" That's my profession. You know what I'm saying? So that's just the way it works. So that's what I'm getting at. So this is a very important chart. So when I show it, definitely keep an eye on it. And like Tim said, he's actually screenshotting the things and keeping it in a file. Do it. And they're all available on the media section of my Twitter feed. So you can scroll down and look at each one of them. Tim, you know that, right? Jose, you know that?
Yeah.
Yeah, on Twitter, go to the media section. Everything is there. So you can open it up, glance over it, take a look at it once every day. Different charts. And in due time, they start talking to you. I'm serious. So that's number one. Number two is the short-term version. So here's the more shorter term picture. Okay? See that more clearly. And I kept on focusing on this trading range. I kept on saying this trading range looks very likely, given what I see on my other screens and my other Thinkorswim charts and stuff that I put out there, that this trading range had a high probability of breaking out. Remember that, Tim?
Yeah, you've been posting that for
a while now.
Time.
Now I'm not posting it because I'm feeling it. I'm posting it because I'm seeing the indicators on the longer term daily charts, which we're going to look at next, telling me the upside is on. They're going to do this. Now anything can happen, right? We could get into all kinds of risks are out there. But I'm giving a high probability move given the circumstances that are present in the market right now. Remember, option trading or investing, but more option trading because it's more shorter term stuff and it moves faster. That's why the big percentage of returns come or losses come is that it's what's the higher probability of getting somewhere. It's not like oh, it's 100% certain. Nothing is 100% certain, right? But it's a higher probability. If you have an 80% shot of getting to getting there, then you're going to take that bet. That's what options trading is all about. I measure the risk-reward ratio. What's your risk versus what's your reward? If the reward is showing a higher probability move to into areas that I keep that my charts are pushing me to, then I will basically trade accordingly and stay long. Understand that? You guys,
Yes, Frank.
yeah, real simple stuff. So here's your trading range. That trading range was, like I said, 14 and 20. That's roughly about 100 in Dow points, 120 Dow Jones Industrial Average, plus minus. All right, 120 Dow Jones points. Freaks people out, obviously, because, stocks move a lot more. So that is what we kept on doing. Kept on going to the upper end of the range, pulling back, going to the upper end of the range, moving sideways. That was the tell. My shorter term charts, that was the tell. It tried to attempt to go higher, failed, went lower, but it wasn't like, if this trading range broke, we would have a nice drop all the way down here. That you make a ton of money buying puts on the short side on individual fast moving stocks, as well as the SPX or SPY, SPX, IWM, Russell 2000, or whatever the case may be. You follow me so far? That's the only if this trading range broke. You could trade the mid end of this trading range too. Remember, there's a line here, right? So that line is it's sort of the mid range. And see how each of these lines, they match, and that's how I draw them. Previous points where the market hit resistance or the wall, or the market broke out. Got it? And that's it's amazing how precise market these charts are. And the only reason they're precise is not because I'm a friggin' genius. They're precise because they're very mathematical. Markets are run by machines, not by humans. Traders don't get it. So when they see this type of volatility, they're not watching the charts, they're not understanding it. They either set aside, do shit, and then they miss out all these type of moves and all the other gains on individual stocks. Now, this is a pretty significant breakout. I had drawn this green box not after the fact. I had drawn this green box 3 days ago, first part of the week. Okay? And this is, I call it the bear kill zone. In other words, that's where the big short squeeze happens. And once you get a move like this, okay, it means that the shorts are covering pretty hard. They kept on shorting the market at this resistance level, which is the upper end of this box, of this trading range, right? So now they're getting squeezed. They're covering. They don't, they don't want to take losses, or they took losses anyway, whatever the case may be. I know why these type of things happen. These type of things happen because a lot of shorts, they try to short the market really hard on these type of drops. But they're not realizing this is a major support level. Maybe they should be all subscribing to my charts and my service. Okay, I'm serious. Think about it. Because they short really hard, and then the market just goes boom. And they're like, what the, whatever. So they start covering their losses. And you understand covering, Jose, right? That means they're buying into, they're covering the thing. And you know that because you've done SPX trading. So bottom line is, they're like, this is a box. I'm telling you. Like all these idiots on hedge funds who are shutting down their hedge funds because they can't trade the market, they should all pay $10,000 a month and have access to my charts. I'm serious. Because these are way too accurate. Now, if it broke below that, then that's a different story. Then the next level of support comes in right here. That's why I have an arrow here. Okay? Right there. That was the first bump post Irma. The Monday after the hurricanes. And then then they probably shorted here too, really hard. That's why you see these red candles. Well, guess what? All the market was doing, and this is important for both of you to realize when you're looking at my charts and trading along with it on individual stocks too. These lines are known as consolidation channels. This is where the market is consolidating. So it moves up really high. I mean, not really high. Let's say, rallies in, and then it slips back, profit taking, but it holds it's basically a profit taking channel. Get it? And
Yeah.
this consolidation channel, when it breaks out, got to start, and now it's a multiple consolidation channel that I drew, 1, 2, 3. And look how exactly it touched this one and started to go higher. So always happens. So a stock moves up, profit takers come in, it does this, and it doesn't mean it's always going to break out. But if it's coming from a much lower bottom, like this one is, then the chances that it's just profit taking are pretty high. That means it's going to break out again. It's also known as what, Tim? Tim knows. What is this? What is this a pattern called? Come on.
That's a bull flag.
Thank you. Thank you. I knew you knew. It's a bull flag. When that monster trade was done, which Tim participated in it too, I'm proud of you on that, on Intercept Pharmaceuticals, and the stock was going like this. It started to, it started to move up a little bit. You had guys in the room, oh, the stock's going to go higher. No, boom, fell again. What is this pattern called? You said this is a bull flag. What's this?
Bear flag.
Huh?
Bear flag.
That's right. A stock is on a major downtrend. It starts to shorts cover temporarily. New shorts come in. Boom, falls again. Stock on a major uptrend. Profit takers come in. Boom, it breaks out. New buyers come in again. Is it always that simple? No. But then I look at many different indicators and stuff and try to make a determination whether it's a bull flag, even though it's looking like one. Because a bull flag can also, for example, break down a little bit, right? And create some sort of double bottom before it moves higher. That can happen. But generally speaking, the simplest mechanics, and you see this a lot. So when I'm showing a particular trade, keep in mind. So this is a bear flag. And that Intercept Pharmaceutical, but then these can be traded too. If something falls from 10 to 1, okay, big move down, and it moves up to 3, you can still trade it from 1 to 3, right? Sure you can. So, but you got to be careful because you got to take your profits rather quickly, because this massive move down where billions of dollars fled or sold is not something that gets reversed that quickly, especially on biotech stocks. Just remember that. But new buyers, when they come in, this can break out too. But I'm just generally saying. Just the way, remember this, and traders just don't get it. Well, most people in the markets don't seem to get it. That when you have a big move on the market, and we're going to look at the daily chart of the S&P 500 on Thinkorswim in a second. When you have a big move in the market, your bias on your options should be on the long side, because that means billions and billions of dollars, $1 trillion went into the stock market. So what does it mean? All of a sudden, they're just going to, $1 trillion is going to leave the stock market? No, unless there's a real catastrophe. You understand that simple concept?
Yeah.
Yep.
Yeah. And you'd be surprised that these type of simple concepts, they just don't get it. In a bear market, you short rallies. Okay? In a bull market, you buy dips. And in my case, the sort of more, not just buy the fucking dip, no, not the BTFD kind, but between levels. You get it?
Yes.
Good. Now, let's take a look at the S&P 500 on the daily. On the weekly, let's take a look at it on the weekly. And this will answer everything that I just spoke about. This is going back to February of 2016, when Tim was 3 years old and Jose was about 3 years old. Okay, and trying to steal your neighbor's bike. All right. So so bottom line is that let's take a look at this. So I'm going to walk you through. After this, we're going to look at a few charts, which is really what the meat is. But we got to keep an eye on this. So if you think about it, and you hear a lot of idiots on TV, and believe me, a lot of smart people too. I mean, I have CNBC on, I have Bloomberg on one of my screens, and CNBC on my flat screen on the top. Sometimes, I put when there's breaking news, I'll take a picture of that and tweet it out. Now, why do I listen to it? Because they do have actionable news. They do have very smart people who talk sense, and I know exactly the ones they are. And those are the ones that time to time, if you notice in the chat room, I will say, listen to this lady. There's one lady called Katie Stockton with BTIG. Man, is she smart? I actually sat in 3 of her seminars way back in 2006, 7. I'll tell you, she's one smart cookie, technical analyst. But in some cases, I've been more righter than her. Believe me when I tell you. Maybe because I'm like totally clueless about things. You know what I'm saying? Maybe that's why. Seriously, I do know one thing, because I have an extensive, I love tracking global politics, economics and stuff. So I'm like really knee deep in it. And it's like reading the sports pages for me. So I tend to basically get a sense of what is really going on out there. That's so those are all incorporated in my investing model, and so that's a huge thing, man. It's a huge thing. So all right. So saying all that, if you think about it, all the way from 2013 till 2016. We actually broke out of the market. The breakout zone was here. And that was back on. Please look carefully. You can see the date up here when I put the cursor. What's the date?
July 11th.
Correct. Thanks. Tim, you there?
Yeah, I have my mic muted so I don't interrupt when I move.
No problem. July 11th, and then a couple of months later, on November 7th, same year, we broke out here, first breakout, slipped below that, big red line, the 50-week moving average. This is a weekly chart, not even a daily. Anyway, the second breakout happened on November 7th, 2016, right? Obviously, that was right after the elections, right? So, so this rally really began on July 7th, which we know, not in July, but in November. Not in July, but in November. So, if you do, so if you look to see what's going on now on the picture, I gotta make this. I posted a chart, which is a big one, on the S&P 500, going back to, people say that the stock market rally started from March of 2009, right? From down here, but it actually didn't. This is the chart that I posted for you guys. Bear with me 1 second. It's really important to keep in mind that this bull market has enough time left to go higher up. It didn't start all the way down here in 2009. Bear with me 1 second. I'm looking on my Twitter feed on the other side. Where is it? Okay, here it is. You guys will love this one. So there. Okay, so let me do this. Bingo. The bull market didn't start here. It started here because this was the breakout. So this says bull market inception, the real facts, not the fake media. You know, they keep on saying this bull market is going on for 8 years now. No, it's not. It started. It actually started on in 2013. This is 2013. Okay, so it's only been 4 years, not 8 years. This was the breakout. This was the big drop, the housing crash and all that stuff. And it started here. I even wrote it down. Read the bottom. The real technical bull market began April 22nd, 2013. We're just 4 years old on this bull market. So it's not like we've been going on this thing for like, 20 years. To make and in between, yes, there have been some severe drops. This was the real danger back in February of 2016 of a real start of a bear market. See, it almost broke that channel. You see that?
Yeah.
Yeah, those are the ones. This is where it gets very tricky because just don't know whether it's going to basically come back and test again, which was possible, the 1600 level. If you Google that period, February of 2016, I can bet you get tons of these media articles from also its powerful sources saying that that's it. This market is going to 1600 S&P.
Mm-hmm.
But once it turned and created, you see those two little candles? That's a double bottom, and it's entered back in the zone. It started to hop its way higher, and now we are in this channel. So at the upper end of this channel is 2600. That's why I have this big arrow. See that? Right there. So 2600 from where we are today is 87 S&P points times 6. So we got roughly another 500 points left on the Dow before it hits the upper end of this multi-year channel. Remember, once it hits the upper end, there is always a lot of volatility or a pullback. You got it? So is it going to be different this time? No, it's not. Once we hit towards the 2600, you can't just short the market and say, okay, it's all going to crash. But there is going to be a period, maybe of a few months. But nowadays things happen so fast, I would say a few weeks, where the market will basically pull back. Now, will that pullback be that big? I don't think so. But who knows? I'll figure it out when we get closer to that. But that's where we're going eventually. Now, will that be something that we go by this month, October? No, I don't think so. But who the heck knows? If we do that, then we have exhausted a lot of fuel. You got it? If in the month of October, the market bounces after a mini pullback, bounces that hard and goes up another 400 points, I am not going to be all excited to keep on going long. At that point, I know, based on technical charting, that you need to basically short the market.
Yeah.
I won't do it on an emotional basis. I'm going to be watching this, but there might be a rolling top. See, it's a rolling top. You see that, Tim? You see that?
Yeah, I see it, Frank.
Yeah, rolling tops, baby. Rolling tops. So it could be a period of rolling tops where the market stays in that zone till boom, back to the lower end of the channel. Now remember, we fall from 2600 to 2200, which is the lower end of this rising channel, right? Blows through the 50-week moving average and all that stuff. They're going to say, that's it, it's Armageddon, it's all over, We're definitely going to short. But 400 points down. Jose, you know the conversion? 400 S&P points is roughly how many Dow Jones points?
I
You have
don't know the.
Okay, I want you to write that down somewhere. Remember it. A conversion is 5 or 6.
Okay.
So one S&P point, very, very important. One S&P point is either 5 or 6 Dow points. Okay? Dow Jones.
Okay, got it.
So if we get 400 points down over a period of months, it doesn't happen in one day. Then how many? If S&P is down 400, how much is the Dow down?
Be times 5, so 2,000.
Yeah. 2,000 or 2,400, whatever the case may be. So 2,000 point drop in the Dow. If you notice, There have been some very serious articles about the market dropping, and what is the percentage? The percentage is a drop of 15%. 15, that's a 15% drop. Okay? So a 15% drop is something humongous. So bottom line is, you will see the likes of the Googles and Amazons, like, boom, they lost 30% of their value. You'd be like, whoa, that's a big catastrophe, but we're going to make some money on it when it happens. They'll never make it easy. But that only will happen if the US economy goes into a recession, if there is a global catastrophe from China, if there is a massive incident, terrorist incident on US soil, we can easily drop 1,000 points, right? 9/11, I remember, I told you I'm a survivor of 9/11. So it's like market drop, everything falling off, and then the market, we were shut down for a week. It's a very stressful week. Okay, 1 week. Markets open, went down a little bit, and started running higher. So, and that was the most horrific incident on U.S. soil, right? So think about it. So that's what markets do. Anyway, so that's it. So long-term picture, solid, and we're good to go. Let's take a look at a couple of stocks. Tim, you ready?
Yeah, I'm ready, Frank.
So this is the short-term picture. This is what I wanted to show you before I leave this screen. Forget about all these notations and the arrows. See, does this look like, first of all, this is shooting higher. That's the stochastics, the underlying momentum on the market or individual stocks. And that's moving higher. That's great. When you look at this, these are very bullish candles. And in between, you get these little red. These are known as a doji. It looks like a red cross. It means indecision. It doesn't matter. Why didn't it matter? Because I knew. Because look at this. This can continue to go higher. If this is continuing to go higher, the underlying stochastics, then this means that the next move is going to be higher. Even though the market jostled around for, remember, in the trading range, for about 120 points for about 10 days, right?
Yeah.
Yep. So that's that little red dot. Remember, this is a weekly chart. So this is 1 week, which was the week prior to last week. Now this. Does this mean there's going to be another big red candle, green candle here? Most likely. But the upper end of this very, very precise range is S&P, and write that down somewhere, is 2570. Wow, 2566, 2570. And if you look at this chart here, it's not like it's going like this. It's not like it's going straight up. It is doing what markets do, which is it possible we get 2570, which is up here, by end of October? Yes. Is it also possible that in between there is going to be quick, sharp pullbacks? Absolutely. What are those pullbacks? As long as that pullback is, remember, this is the big channel, right? Upper end of the channel is 2600 and change. Lower end of the channel is 2427. That's a long way down. But as long as this holds, this channel will continue higher. All right. Now, Jose, any quick questions so far?
I did have a couple questions.
Okay, mate, go ahead, because it's 10:43. Go ahead.
All right. So I know how you talked about when the market dips down like it did in February.
Yes, those are big dips, big.
Yeah, and like it almost gives you like the flag that it's breaking below, right?
Yes.
That support.
Yes.
How do you deal with all that negativity in the market?
I don't deal with it. I don't deal with it. And how do I say I don't deal with it? First of all, I have more information on the market because, just from my experience, number one. Number two is I am looking and focusing purely on these type of candles and determining what is going to happen. I keep my trades smaller in duration on these type of drops. Or if I see a candle this big on a weekly basis, I will certainly be short, because this is not something that reverses right away. I'll be looking at all my different indicators, including these moving averages. This one being a very powerful one, known as the 150-day moving average. A break below that, you remain short. You see a reversal candle. So I cut out the negativity. See, I don't deal with negativity that much to start with. I deal with stress. I deal with stress and I try to make that positive. You know what I'm saying? I get whacked on a trade on a short-term basis. I get more hungry, and I'm not kidding. And again, I'm not doing one trade. I'm doing multiple trades. But let's say one trade, for example, I will get more hungry to go out there and make 3 times more back, because winning to me in this business, which is my career, is not a choice, not an option. I gotta do it. So bottom line is, I rely, in order to suppress my emotions, in answer to your question, the more tactical and technical you get in looking at the markets, the better off you'll be able to deal with the negativity that's all over the place. And now that you're in my service, you're going to get the real facts of what that is, and that will help you cut out a lot of the garbage that you hear, because all the reporters are doing, they have no frigging idea why the markets go up or down, and they keep on changing their tune. Remember, we used to say on Wall Street, by the time it comes out on TV, we already done the trade, because they're reporting. They're always reporting after the fact. So in my service, you will learn more by the way I approach the markets in the most difficult circumstances. Okay, this is the daily chart of the same picture. Upper end of the range is 2568. Still, wow. So by relying and becoming more robotic. I am very robotic. I can't expect you guys to be like that yet, but I am very robotic. Ask Tim, he's been with us a couple of months. Even on the most dire markets, where the markets open down 200-300 points, I am basically pinpointing the exact levels where the market's going to go. I stay like a robot. So it's just practice and just the way I am. So next question.
All right, and I know you're showing us like the last week how it's been like a sideways market.
The last week was a sideways market till we broke out on Friday in a monumental way. Correct.
And how do you set yourself up, like timing wise? How do you know?
Okay.
Like, this
yeah. So basically, what that's a good question. So let me just get back to this. Get back to the chart. I rely purely, and I'm not kidding, purely on my charts. And here is how it's done. And it's not that hard. Just have to mentally stay thinking. So here's your choppy market that you asked. This stuff is going on, right? And we're doing some short trades, and you know, we're doing. Remember, even in this type of market, we're talking about index trading here. But even in this type of market, multiple stocks are going the other way. You know what I'm saying? Just because we drop doesn't mean all stocks drop. You know, a couple of my stocks went through the roof. Not the big biotech, not the big tech stocks, and they generally follow the market. So depending on your time frame, you're talking about a swing time frame, I would be accumulating as long as this box holds. This is the best answer I can give you. I keep on buying the further dated calls on the market, SPX calls. And I keep on accumulating. Like I said, if it's 4, it goes to 1, I'll buy more. If it goes up to 2, I will either sell or buy more. Most cases, buy more, knowing that this breakout is a high probability trade based on multiple factors, not just one chart. So I will be a buyer or accumulation over those past couple of days, like I did, and then enjoy the fruits of my labor as this big breakout happens. You could certainly take profits, no question about it. And then and I still have a balance left that's going to basically get to my level. So I would be a tactical buyer overall on the S&P or the SPYs And if you have time, you can actively trade it during the day too. But generally, you want to be a buyer, not a seller, as long as this trading range is intact.
Okay.
Yeah. And as you practice it, you'll see. You'll see. Now, trading range breakouts of this magnitude is not a fantastic, beautiful event unless you were a buyer, like I kept on showing at these levels. Buying it all the way here, where the market, or like a lot of traders will do, buying it here is a suicide attempt, because right there, the big sell programs will come in. You get it? So the only way you can enjoy the fruits of your labor is to basically go through this volatile period and tactically accumulate a position, and you would be a seller into this zone, not a buyer into this zone. So what does the average trader do? They start chasing the market here. They're going to get slapped again. It's the same old story. We were positioned pre-Irma. Okay, we were positioned pre-Irma before the hurricane, and moderate positions. And when it gapped up, we just nailed it. This one gap up alone would make your month. But if you were not positioned here, let's say for example, or I told people to buy here. That's why there's an arrow here, and you're chasing it up here. You're not going to make any money, because the market will then go in a sideways pattern. You're like, what the, whatever. And then if you're not buying here, you're not going to enjoy this. That is predictive analytics, which I produce. I deliver all the analysis and the charts and stuff. It's up to you to basically buy and hold those type of circumstances. Now, if I did see a breakdown, I'll be the first one to alert that the range is broken. Now we're going to go lower. You got to switch position. That a trader has to be flexible. But 100% of the time, if you're not positioned right, then what do rallies mean? Big breakouts like this mean nothing to a trader, because they did not own it in these zones. Am I clear with you guys both on this?
Yes.
And that's the reason. That's the reason, gentlemen, that you don't see real excitement anywhere. You don't see guys mobbing the chat room. They're great people. It's pretty quiet, which I love it. That's fine with me. Okay? Tim will come in, pop a text or whatever, but generally quiet. Why? Because a lot of bozos out there, despite all my hard, diligent work, are not positioning themselves right, because they are, excuse my French, shit scared to the point, because they're just looking at these minor volatility moves. And they're like, oh my God, here's, and that oh my God cost them a fortune, because they did not enjoy this type of powerful move. That is the simple truth. Problem is, some refuse to change and accept the disciplined approach to markets, and then many, like you both, are making a diligent effort to understand the realities and the disciplined approach to the markets. That's the difference. Because this breakout doesn't mean we're just going to go straight to the moon, as they say, right? It simply means we are approaching a zone where they are going to sell. Now, is it possible it just rips higher? Sure it is. Great. But even when we ripped higher, this is the same type of move, by the way, that we saw here. Remember, this is the fastest move. Then it slows down and goes into a range for a couple of days. So if that's the case, then you got a little bit more to go before we go into a range. And range is when you can't make that big money. You make big money on the breakouts.
Mm-hmm.
Right. But in order to do that, you're going to be positioned in these levels. And this chart, this particular chart especially, was extremely clear that we were just in a trading range. Now, there are different patterns here, which I identified too. It's called the inverse head and shoulder, head, left shoulder, right shoulders, retest of the consolidation channel. That's all technical stuff. But it was pretty clear that this was the zone you needed to accumulate so that you could enjoy this type of breakout. Now, there's more room to move a little bit. Maybe it moves much more room to move. I don't know, but we'll see. So guys, it's 10:54, and I will be hosting a session tomorrow evening, like I do when futures open, possibly around 7 p.m. or 8 p.m. Eastern Standard Time. Feel free to join that. And in the meantime, like I said, keep on. It's perpetual learning, guys. There's nothing that is like, oh, I just know everything. I don't know everything. I really approach the market like I honestly, like I started trading yesterday. I'm not kidding you. I'm not doing. Let me just put it this way: my calls, the way these forecasts and these individual stock moves and stuff. I'm going to pull up a stock before we leave. Are so big. I should be making 3 times more than I'm making, and I'm doing pretty well. And I'm telling you that right now, because volatility even stops. Remember, the bigger your positions are, the more nervous you get on. The more nervous you get when you're trading. You guys understand that part, right? So
Yeah.
some people say, oh, I wish I had more money. I say, hey, if you're like learning and you're not that good at this, it's like high-speed driving. It's like you put somebody in the wheels of a Lamborghini, they're going to be wrapped around the tree or in a ditch in 2 minutes, because volatile market volatility management is like driving a very powerful, V8 or V12 with 800 horsepower to the wheels. Seriously. So the bottom line is that the lesser money you trade with, you get a better chance to make more, because you're going to be holding those trades a little bit longer, sticking to my charts and stuff, than if you're trading with big money, which can disappear in a flash, because you'll be tempted as a retail trader, as a human being, to bet more. Correct?
Yes.
And what's going to happen? You're just going to get whoosh, chunk gone. That is far more painful and devastating to your mental state in the world of trading than if you lose a little bit on a smaller amount, which is technically the same thing, right? Percentage wise,
Yeah.
except lesser money. So get better. That's when you press the gas. Now, one of my classes, I talked about momentum trading. Go review that ACS too. I'll be doing one more of those things. Momentum trading is when you hit the gas really hard. When you start to see this, this is the simplest chart on price line that we traded like a complete beast. I alerted price line twice, here and here. One of the members, I put it up there, bought price line calls based on my alerts on Thursday at $1.50. He sold at $10.50.
Wow.
This happens quite a bit, believe me. Okay. I had different series of calls, including that. One, my average cost was 50 cents. It went to 15 cents. I bought a heck of a lot more because I was looking at these charts. Price line is a very powerful manipulative stock. But this chart was clear. It's in a trading range, right? Those 50 cents calls went to almost 50 cents. That's 300%. 200% plus. I had a bunch of them. This is not the first time. So if you followed this chart, you know that price line wants to trade between 1844 or 1840 and 1800. It's not rocket science. Now, yeah, I can draw patterns on this and this and that. Upper end of the range is 1860. I even pushed out some alerts on Friday to buy October 20s of price line at around that 1860 level. But cheap calls. Look what it did. Look what it does. And it drops like that too. And it faked out a lot of people with one red bar. Like I was showing other charts of price line too. And then it woke up on Friday, and it wasn't a straight line, but it opened up, stayed green, and then went up. From here to here, it's $33, dude. $33. Yes, it's $1,000 stock, so what's $33? $1,800 stock, but still, $33. A lot can be had. And all they had to do was trade off this chart and my alerts and buy a little bit. These are the types where I will not buy expensive options. I'll buy cheap ones because based on my charts, I'm expecting a $20, $30, $40 move. So you buy those $1 ones, they go up 800% or 600%, 150 to 1050. You know what I'm saying?
Mm-hmm.
So I'm not going to spend $10 buying a call. Let's take a look at another one. For example, Amazon. I said the stock was going to hit 965. Look at this chart. Can it get any better than this? So here was a perfect double bottom on the stock at the 931 level. And initially, and before we had actually also shorted Amazon on this move down. Now this is a beautiful channel, Tim, and you should know now, what is this pattern?
That's a bull flag.
Thank you very much. Now, unless something changes, this bull flag, by the way, can slip to 954 again. That's why this is, what is this called? When there's a gap like that. Well, I answered the question. It's called a gap fill. And the chart that I put out there, which is this one, but with annotations on it, this is the gap fill. So is it possible that I said it's going to fill the gap? It filled the gap and went well above that to the next level. I said 965. The stock hit 964.83. Now you tell me if that's, I mean, what more can somebody do? I mean, I'm like, the 960 calls and 965 calls, boom, through the roof. The lottos, which were expiring, the 960s, went from $1.80 to $4, and then $2 to $5. So is it possible that it drops 6 points? Remember, it's 961 the stock closed at. That looks like a little hammer, but it can easily drop $4 or $5. That's just these stocks do. But there is support here, upper end of the gap. So I would look at the market. I would look at what's going on. And if there's not, sometimes there are big sell programs on one sector, right? Tim, you know that, right? So all day long, that sector. And you notice how they shift. One day it's biotech, one day it's energy, one day it's technology. Very seldom all four of them go up at the same time, right? Like it's that's just the way hedge funds do it. They just they said, okay, we're going to trade the crap out of this sector today. So, and then the other side is red. Just happened 2 days ago. These things were on sale because these big hedge funds were basically just saying, okay, we're just going to short this side. We're going to keep on buying energy. Like Marathon Oil. The calls went from 20 cents to $1.40. That's 600%. Yeah, it took 10 days. So what? I kept on showing the chart on MRO. So bottom line is they pick one side and they do it. Now, is it possible that it comes down here and then ramps higher? Very. Or it just gaps open and goes into this channel. That's why I draw these channels, right? It goes into this channel. Remember, this line is a downtrend line, right? You guys can see that, right?
Yes.
Okay. So once it breaks the downtrend line, you got automatic short squeeze programs. And those will get up to the next level that I drew, 982. Is it possible that this baby goes up $20? Absolutely. And at that point, there was a big fat sell candle. What does that mean? It's just going to blow through it? No. There's going to be big sellers here. Big sellers means it can easily drop 6-7 points, and then if it wants to go higher, it will. In my opinion, Amazon wants to go back towards this 980 level. After that, we shall see, because that's where most of the selling happened. That's known as a supply zone. Got it?
Okay.
Show you one last chart from a swing trade, because you asked some terrific questions on the swing trade side, to basically sit patiently and just follow the charts to make you money. And that is Marathon Oil. I drew this chart a while ago. I showed the double bottom right there. This is a double bottom right there. You can call it, there was a double bottom here too. Since that double bottom, oil recovered. The refineries came back to live, right? After Hurricane Irma. They started, because they shut down the refineries. This stock, for stock alone, it went up almost 30% from here to here. Other side from 1 day drop. And look where it hit. Is this anybody with half a brain can understand this chart? There's a downtrend line. It went above that. There was a little sell program. Doesn't matter. I told people to position themselves all in this zone. All in this zone. Few times. This was a 600% swing option play. Swing. And he didn't have to allocate huge amounts of money either. Just have to follow this particular chart. Now, what was the date here? They're double bottom. So you could have bought here and bought more here because this started. A double bottom formation is huge. I even called it a W formation, known as a dragon bullish. See that? What date was this? Let's call it end of first of September. So this was a multi-week swing trade. This was a multi-week swing trade which could very easily been tracked and profited from because the charts were clear. There was a big trend line here. Forget that one. There's a big gap here. I called it a gap fill. When I posted the alerts, I actually wrote gap fill down here. I knew this gap was going to get filled. It got filled here, and I said, okay, it's going to get filled again. Well, guess what? It did get filled. There's a secondary downtrend line here. You guys see that?
Okay, I see it now.
Yeah, I see it.
Okay, so here's a trick. It's not a trick. That's the way it works. Let's say you missed this ultimate buy point. Sure, no problem. But once you break through the intermediate downtrend line, okay, you got to be buying. And right after the intermediate downtrend line, it went on a real ballistic move higher. Even though this move was nice too, it could have hit the downtrend line like it almost did and done what? Sold. That's exactly what happened here. But once it crossed over the downtrend line, it's a gunner. Powerful. And oil, of course, supported it. That's fine. Huge trade. Missed by almost majority other than a few people that I know who just held on, made a ton. And you don't need to put hundreds of thousands, you don't need to put thousands of dollars in it. You put a couple $100 in it. The lot is what, 20 cents, 22 cents. Let's say you got in at 40 cents. Doesn't matter. They went to $1.20. And it looks like it wants to go to 15, which is the last level of major support. Hold on. All right. This is where the stock's going, guys. So we still have room to go. Because remember, this is the big candle where it sold hard. Patterns get replicated. I tell you, I've seen this happen way too many times. I'm a believer. It doesn't mean it's going to happen in one day. It takes days. That is the answer to your question, Mr. Jose, our new member, to a swing trade where you hold on as long as the directional flow, the candles and everything are going the right direction. Do you understand?
Yeah.
Exactly. Problem is that retail traders have no patience, no discipline, and always do stupid things at the wrong times. On a minor red candle, they'll probably be selling out. Or intraday, these candles were not always green. They were maybe moving around a bit during the day, right?
Mm-hmm.
They're selling out. I can't do anything about it. Guys, I mean, people have to make a determination. At this point, I got to start wrapping up. Okay. At this point, this is the zone where the stock is going. See the pattern? See the pattern? There you go. Now you start getting excited right here. Well, yeah, but there's big sellers here because this is where they got blasted. So they're going to be selling here. Just the way it happened here. So what's the point? Can it break out over the? Sure it can. Anything can. I'm just giving you the technical high probability move of what is happening. There is still room for the stock to move higher. As you can see from the charts. Not my feelings. Now, in the meantime, this lovely color scheme is known as a Fibonacci retracement. And that Fibonacci retracement right now, I don't want to get into it too much, is arriving at 0.5. That means at the 50% mark. 50% Fibonacci retracements, as I've said hundreds of times, is standard procedure on a big climactic drop. This was an all-time low for the 52-week low for the stock. 50%. Once it reaches the 50% level, you tend to get either an overshoot to the 61.8% Fibonacci retracement. Read up on Fibonacci on Investopedia or Google it, and you'll see. But normally, a 50% retracement is standard procedure. A 50% retracement of when the stock was 20, went to 10, and now going to 15. I mean, and now went up here at the 50% level. All right, guys. So that's an answer to a perfect classic trade where you needed to just sit there. Unless there was a change in trend or something happened, like it broke below this trend line and stuff. That's a different story. In the meantime, this movement here was a lot more choppier, but this one is pretty straightforward because a lot of money went into the energy sector, right? So that helped. That helped. All right, guys. Have a great afternoon, day. Look forward to having you guys attend if you can. But this covers quite a bit. But tomorrow's evening's weekend update, and we're getting ready for next week. In the meantime, get a heck of a lot more referrals. Stuff you're learning, nobody's going to teach you like this. They're going to teach you a lot of basic, a lot of good stuff in other places. They will never teach you the advanced stuff. Maybe they don't know. I don't know. On that note, have a great weekend. See you both.
You too, Frank.
Bye-bye.